18 EBIXCast Studio.
Hello and welcome to the CNBC TV 18 EBIXCast Studio. I'm Sumaira Abdi and you're watching MF Corner. Over the next half hour today, we'll actively focus on the passive investing landscape in India, the current trends and what's possible in the future. SRE Wealth's Keerthan Shah will explain some popular smart beta strategies, and later Prableen Bajpai of FinFix Research will tell us about some innovation which could, perhaps be a possibility in India in the future, leverage and inverse ETFs. But first up, let me invite Keerthan Shah, co-founder and CEO at SRE Wealth. Hi Keerthan, good afternoon. We're increasingly hearing about smart beta. So what exactly is smart beta and what is their use?
Hi Sumaira, thank you so much for having me on the show. So Sumaira, Smart Beta Fund is somewhere in between active and passive. Assume Smart Beta funds to be a passive plus a small variation as a strategy. Now there can be two types by which these Smart Beta funds can actually be constructed. Now it can be made by simply making some very simple changes to an existing index. Like say, if I change the weights of the 50 stocks of which Nifty index is made, I can come up with a smart beta fund. Or the other way around, what you can do is you can completely create a new index which is based on some predefined rules. Of course, now in both of these cases, the objective is to try and reduce the risk, enhance or improve diversification, and also be able to still traditionally be able to beat the benchmark against which these smart beta funds will really be made. Now, currently, if you look at it, there are multiple themes on which these smart beta funds are really based. So there is a value theme, there is volatility as a theme, there are funds around momentum as a theme, quality as a theme, and there is also these broad-based participation as a theme on which these smart beta funds are actually made. So to give you a couple of examples, Sumaira, if you look at something called as a Nifty 50 equal weight or a Nifty 100 equal weight index fund, typically what they've done is it represents the broad-based participation theme as a part. And similarly, if you look at Nifty 100 low volatility 30 index, for an example, it's actually representing the volatility theme as we discussed. So there are multiple of these funds which are based on these specific things that we spoke of. You can largely look at these smart beta funds as funds which are more passive in nature, but trying to generate slightly higher returns than the index, but reducing the risk and bring it lower than the index. That's the larger framework in my opinion.
So basically, you can use, whatever of these unique characteristics you think, will add value to your portfolio. You can choose a smart beta accordingly. So let's try to understand some of the more popular, of these rules. One is, of course, index weight fund, which would allocate equally amongst all stocks, right? The equal weight. Why and when is this kind of a strategy useful to investors?
So Sumaira, let's, for an example, take the Nifty 50 equal weight. Like you rightly said, that all of these 50 stocks of which the Nifty index is made, instead of the traditional index in which different weights are given basis market cap and free float, over here in this particular fund, all of these 50 stocks will be given equal weight. Now, what that typically does is that in your traditional index fund, the top 10 stocks out of the 50 will have a composition of 58.74% of the total weight. But what happens in this particular fund is the top 10 will have only 20.26% weight. Now, what typically this fund is trying to solve as a problem is when the markets are expected to have a broader rally, or you are expecting the entire economy to do well and multiple sectors to do well, then probably such a kind of fund which will broadly participate in the index will make more sense over a traditional index. Now, even if you look at some data points, if you really look at the 3-year rolling performance of this particular strategy, you will see two very particular things which will kind of re-emphasize what I'm trying to say. So the equal weight fund has been able to outperform Nifty 50 on a 3-year rolling basis across all time frames, 3 years, 5 years, 7 years, 10 years. But if you look at the longer time frames, which is 7-year, 10-year, in which broader participation of market is slightly difficult, in those time frames, you will see that the minimum return generated by the traditional Nifty fund is better than the smart beta. So largely we are saying that these funds are very apt when you are expecting broader market participation, Sumaira.
Kirtan, what is this low volatility strategy? I mean, what is the strategy here to avoid the volatility in the market? How is it done?
So, Sumaira, again, let's look at this example of the Nifty 100 low volatility 30 index. What it typically does is from the Nifty 100 as an index, it will try and select a universe of 30 stocks on the basis of lower volatility. So whichever stocks of the 100 stocks will have the lowest volatility, the top 30 will be brought together to form this particular index. Now, whichever stock has the lowest volatility invariably will have slightly higher weight in the portfolio. And this index is continuously rebalanced on a quarterly basis. Again, if you look at some historical backtested performance, you will see that the 3-year rolling returns of the low volatility index is clearly an outperformance over the Nifty 100 as a benchmark. And specifically, it brings in that kind of outperformance with lower volatility, which is the intention of the fund. So yeah, Nifty 100 low volatility 30 index is the fund that you should look at if you're looking at lower volatility, Sumaira.
Okay, so how do you chase momentum then through smart beta?
So Sumaira, it is something very similar. So now you can look at this particular fund called the Nifty 200 Momentum 30 Index. What it typically does is exactly the same way that we spoke of the last fund. It brings in the top 30 stocks together out of the Nifty 200 as a basket. Now, on what basis does it? It typically follows a pro-cyclical theory where it is saying that I will bring together the top 30 stocks in a way that have been performing well over the past X number of period. And the theory is pro-cyclical, like I said, where the index or the fund is expecting to buy the stock higher and sell it even higher. Again, if you look at the performance of these funds on a rolling basis, it has clearly outperformed the respective benchmark over a consistent period of time in backtesting, Sumaira.
Okay. Kirtan, so how do people make this selection? I mean, how do they know which is the strategy that's going to work for them?
So, Sumaira, let me split this question actually into two. Now, I'm not sure of how others would generally do, Sumaira, but for me, portfolio construction actually is a mixture of multiple things. So while you're trying to create a portfolio, you would want to diversify across market caps, you would want to diversify across geographies, you would want to diversify across investment style, growth value, and also you would want to diversify across risk metrics like investing in momentum or investing in low volatility. Now, so if I have existing funds, let's look at case one. If I have existing funds and I want to do top-up investments or more investments, what I would typically want to do is look at where my existing investment is invested. So if the current funds where I am currently invested, they follow a growth strategy, then I would want to add, let's say, a smart beta value fund, which brings in the diversification. Or let's say if the kind of portfolio that I currently run is more momentum driven, then I would want to add a low volatility smart beta product because that brings in the kind of diversification that I really want to put together a portfolio. But let's say if I don't have an existing fund, Sumaira, and I'm trying to invest actively in the market today at this point in time, then if you look at historical data points, you will understand that when markets are available at expensive valuations, and this is subjective, but whenever the markets have been expensive over a 10-year data point, you would see that the low volatility or the alpha low volatility kind of funds would perform better. And if and when you get a market opportunity where the market levels are not very expensive on a 10-year historical average basis, that is a time a momentum kind of a strategy will do well, Sumaira.
Understood. Kirtan, thank you very, very much for explaining these. These are truly interesting times to be living in. And this is a space where we are going to see the maximum innovation in the future. So I'm very, very excited for this segment. Thanks very much once again for joining in.